Michael McKee, we were skewered. He went right after us 15 years ago, writing in Harvard International Review. Harvard, Robert Shiller, is a small school up in Boston. Writing in Harvard International Review, Robert Shiller on exuberant reporting, media, and misinformation in the markets. Is that what we saw last week, Professor Shiller, with our Fed coverage? Is it just too much information?
Well, I do think the media likes to focus on concrete stories rather than deep psychological or what people are worrying about story. And the FOMC gets too much attention. This idea, whether they'll raise now or in December, I think was
You should be careful what you say. You are in the corner of our Bloomberg radio studio, and we will close the Laureate gates so you can't get out.
What is important to the economy these days? If it isn't the FOMC, what should Americans be paying attention to?
Well, I think this will sound very commonplace, but we have seen a stock market that between 2009 and 2014 almost tripled, and now it's bouncing around. It hasn't really moved since a year ago. Well, it went up and it came down. I think that people are reconsidering and wondering, hey, is this time to get out? But that they're tempted to stay in because it's been going up.
Is the stock market what's the relationship between the stock market and the economy? If people get out, does that really affect the overall economy?
Well, of course, people can't get out as en masse. One has to sell to someone else, but the price can fall. Now, one thing that George Akerlof and I emphasized in our previous book called Animal Spirits.
Excuse me, Rich, that was a terrible shameless.
Is that the economy is driven by stories. And one very prominent story is the story of stock market crashes being a leading, or not even crashes, corrections can be a leading indicator. So I think people at this point in history are worried. I don't know what that means necessarily for the future of the economy, but I think it's kind of a volatile time. We've seen the VIX go up.
You do tremendous work on economic history. Is that story true about stock markets and corrections?
The leading indicator school of thought, when it was first born in around the 1920s, immediately picked the stock market as a leading indicator. It's not reliable, but it's well known that it does sometimes forecast
sometimes.
Often. Well, the famous from Paul Samuelson, the stock market forecasted 12 of the last 9 recessions, something like that.
With the speed of information, Professor Shiller, are we asking too much of our institutions? And specifically, are we asking too much of the Federal Reserve, the Bank of England, the ECB, the Bank of Japan?
Well, first of all, we should thank all of those for averting a depression in 2008. I believe that the psychology was changing in a nasty direction, and people would have curtailed their spending much more if we allowed things to happen. So, first of all, thanks to all of it, and there was international coordination of these efforts. But on the other hand, they didn't stop us from having a weak economy. We're still suffering years.
Is it weak enough now for a new demand stimulus when you look at a global mediocre a la Lagarde?
Well, I think that some kind of fiscal stimulus, it would be appropriate now. That's correct. On the other hand, I think that maybe a small interest rate increase would be a way of showing concern about the high valuations. We're in this funny situation with weak economies. We have been. That's becoming less obvious now, and high asset prices.
Well, you said the Fed and the other central banks averted a global depression, but then did they go too far? Were they tempted to do too much because of the lack of fiscal action?
Well, it would have been better if the fiscal action were stronger. We thankfully have central banks that have gone pretty aggressively. Could they have gone further? Well, once you push the interest rate down to zero...
Well, actually, should they have even gone as far as they did? That seems to be one of the arguments out there, that because there was no alternative, central banks assumed roles that they should not play in a functioning market economy.
It would have been better if we had more fiscal policy, more fiscal stimulus. And at this point, I think we should also ask, there's an old idea that has been bounced around since Roosevelt's day. The Public Work Reserve was set up by Roosevelt in 1942 to plan ahead for the next recession. The problem is it's hard to do fiscal stimulus because you can't start these projects instantly. You have to have a plan for it. So that's what we should be doing right now.
Maybe an infrastructure bank?
That would be one name for it, right. So I like the Public Work Reserve, because it's a venerable title. It's emphasizing what to do when we have the next sign
Federal
of weakness.
Reserve, Public Work Reserve.
Well, this would be, right. Part of the government.
We have to, in the final minutes that we have with you, have to speak of overvaluation. Is two disparate groups. People are either agreeing with Robert Shiller that the market is of a high valuation, and others say Robert Shiller's nuts. Describe for us how you value markets, and are we overvalued now?
Well, I have a couple of indicators that I've developed. One of them is the CAPE indicator, cyclically adjusted price earnings, that John Campbell and I developed. And another one is my valuation confidence index. The CAPE index measures the actual valuation of the market. The other one, which is on my website, is a survey data that asks people whether they think the market is over or underpriced. And right now, we've been seeing, in the last couple of years, we've been seeing slippage of the confidence of the general public. This is very important. Not only is the market highly priced, but the public thinks so. And that's a problem. After we get volatility in the market like we've seen lately, there's a chance that the public will decide differently. They'll take action on their fears that the market is overvalued.
Then why are we in a 6-year bull market?
Why? I'm sorry?
Why are we in a 6-year bull market?
Well, I didn't predict it, so I can't claim special knowledge. I have in my I had a new edition of my book, Irrational Exuberance. I like to list what I call our precipitating factors that drive the market. And then there's feedback that amplifies them. Mm-hmm. So there's a number of precipitating factors. And the ones that I listed were, first, the end of a depression scare. We know that in 2009, well, 8 and especially in 2009, people were genuinely worried about a return of the Great Depression. We know that from Michigan Consumer Sentiment Survey.
I saw it in my mail.
Yeah.
Right, and every prime minister around the world was saying we have to take action to avert a depression. And that evaporated as the economy came back, and that's a stimulus to upward movement. Then we have the Fed policy around the world, and we had some government stimulus policy that brought confidence back. But beyond that, I like to emphasize also that there's a perverse effect boosting markets recently, and I think it's an effect of a kind of fear and anxiety that promotes people buying stocks. It's a fear of new technology, and it's a fear of inequality, fear that maybe I will be on the wrong end. Mm-hmm. It's a long-term fear that I think people have now. When I take a taxi, I ask the taxi driver, do you know what your children will be doing when they grow up, or 20, 30 years from now? And I get an answer often that's tinged with anxiety. That I don't know what they'll be doing. The world is changing so fast.